Today we're going to be talking about receivables. There are three primary types of receivables. The first one is called accounts receivable, which we've been talking about since chapter 1. Accounts receivable is when somebody owes you money, but you expect them to pay within 30 days or less. Obviously, we do not have to attach interest to these payments because they are quick and simple. Hopefully, when the person pays you, you collect the cash, it goes away as an accounts receivable off your book because they don't owe you money anymore, and life goes on. Today, we're obviously going to be having to tackle the subject of what do you do when somebody does not pay you. So we'll get there in just a second. The second type of receivable is a note receivable. This one is different because it goes from an account receivable where you have 30 days to a note receivable, which means you're going to have longer, the person's going to have longer to pay you back, but we're going to have to attach interest to that payment. So obviously that's going to be a different level rather than account receivable where there's no interest. The third type of receivable that you sometimes see on a company's books are called other receivables. Typically, if you see that on a financial statement, it means that the company has loaned their employee money for something. It usually is either to go to school, and so some of you may be on a student loan from your company. A lot of companies like to send people at their company to college because they want their employees to be better educated. So what they'll do is they'll say, hey, we'll send you to school and you will either have to pay no interest or very low interest back to them. So if that happens, it's called an other receivable. Obviously, they're going to receive the money from you, but at a very low interest rate. Another type of other receivable that you see occasionally are for companies like law firms, CPA firms that are partnerships. And when a person buys into the partnership, they have to pay a big lump sum to actually be a partner. Well, a lot of people don't have $100,000, $200,000, whatever it is laying around. So they set up an other receivable with the company, and the company will receive a portion of their paycheck until that big lump sum is paid back. So if you ever see other receivable on a company's books, it's usually either a loan to an employee for student loan or for a partnership. We actually don't really cover those in this class. We stick to account receivable and note receivable. Today we're going to be focusing more on accounts receivable. A couple things that's really important to remember is that when you have a company and you're letting people leave with your good or your service, you really need to be careful about who you're letting do that, because obviously there is a risk that that person will not pay you back. So what do you do to prepare yourself for that? Most companies look at a history. How many people, percentage-wise, over the past couple years haven't paid me back? And to say that 100% of people are going to pay you back is unrealistic. I will tell you though that since I've been teaching this class over almost 2 decades, it's changed quite a bit. It used to be a big problem, I'll be honest with you, that people would leave with goods or services, the company would send them a bill, and they would not be able to get the money from the customer. However, something has made our life a little bit easier, and that's called credit cards. What happens with credit cards, if you swipe a credit card to maybe it's MasterCard, Visa, American Express, whatever it is, they will pay the company. But then obviously MasterCard, Visa, American Express has to get the money from you. So companies don't have as much bad debt where they don't receive money because the credit card companies actually pay them. But they, MasterCard, Visa, American Express, then they have to come after the person who owes the money. So it's changed a little bit, but still there is that element of bad debt, people who don't pay. So we still have to talk about the journal entries and we still have to discuss it, even though the percentages have gone down quite a bit, which is nice for companies about this bad debt or uncollectible debt. So let's talk about it. First of all, in accounting, the rule is we have to use what's called the allowance method. There is another method, it's called the direct write-off method, and your book covers it. It's not considered a generally accepted accounting principle because it has a timing issue. it doesn't follow the matching principle. The matching principle says you have to match revenues and expenses in the right time period. So if a person has incurred the revenue, like they've actually purchased the product in a particular year, we need to match the bad debt expense to that particular year. The direct write-off method does not do this. What we do in accounting that is generally accepted accounting principle is the allowance method. The allowance method says at the end of every year, we're going to do an adjusting journal entry. Back in chapter 3, we learned adjusting journal entries, and we didn't talk about this one because it's a little bit more advanced, but now we're ready for it. Obviously, we've covered a lot of topics since then, so hopefully this won't be too confusing. The allowance method says at the very end of the year at 12/31, you really need to consider how many people are not going to pay their bills to you. So that's called bad debt. How many people, percentage-wise, are probably not going to pay you? So if you have thousands of dollars sitting in your accounts receivable, you'll probably come up with a certain percentage of that is uncollectible. When you do that, you actually have to make a journal entry. So I put some numbers up here just so you can see what it looks like. On 12/31, let's say we sit down and analyze our accounts receivable and we think about $2,000 won't be collected, just based on prior years. So you would debit bad debt expense, thereby matching the expense to the revenue in the right time period, and you would credit a new account for us called allowance for uncollectible accounts. Now, there could be money, allowance for uncollectible accounts is not perfect. There could be money left over from last year, or you could have not prepared enough last year and you could have a balance on the debit side, meaning that you went over. So you might have to consider that in some of your homework problems or test problems. You'll have to look at that, and it will tell you, and the problem will say, you have $500 left over in the account as a credit, or it might say you have $2,000 left over as a debit, or whatever. So it will tell you that in the problem. I didn't get into that in this. I just wanted to show it to you as far as the journal entry. So debit bad debt expense, credit allowance for uncollectible accounts. Some books call it allowance for doubtful accounts. Either way is fine. Allowance for uncollectible or allowance for doubtful accounts are the same account. So depending on what textbook you're using, it can be called differently. As soon as you realize that somebody is truly not going to pay you, a particular person. This is in general, you set up this account. Let's say in February, we get a letter saying that one of our customers went bankrupt and they owe us $500. If that happens, then you do the journal entry that's called a write-off. When you write something off, you take the money out of the allowance for uncollectible accounts, so you use it. So we started out with $2,000 in there. When you do this journal entry, you're only going to have $1,500 left in that allowance for uncollectible accounts because we're using some of it to write off this particular person. So the accounts receivable would actually have a name on it. It could say accounts receivable M. Blandford or whoever, whatever the person's name is. So you're actually taking their account receivable off the book. You said it's not going to happen. They're not going to pay me. And that's perfectly fine. It does happen sometimes. If a couple months pass and you go to the mailbox and you receive a check from M. Blandford for $500, you're like, what? That's crazy. That's called a recovery. A recovery is when somebody that you previously wrote off and you thought they weren't going to pay their bill comes back and actually pays you. Now, I will be honest with you, in practice, I've really never got to make this journal entry. I've never seen it happen, but we have to show you what would happen if the person does find their conscience and decide to pay you back. If they do that, there's actually two journal entries you have to do. The first one is you reverse the write-off. So you debit accounts receivable, credit allowance for uncollectible accounts. Basically, you're saying, this didn't happen. You're reversing it, okay? Then you do a regular journal entry where you collect the cash, debit cash, and credit accounts receivable. So you have to do two journal entries for a recovery because obviously you're reversing the write-off and then you're collecting the cash. So there's two things that are happening there. So the allowance for uncollectible or allowance for doubtful accounts prepares us. As accountants, we do not like surprises. We like to be 100% prepared. So this allowance account says, hey, we are realistic and we know some people aren't going to pay us. We think it's approximately $2,000 worth that we won't collect. This is not an exact number. Wouldn't it be great if we had $2,000 set aside? This person, at first we didn't think we was going to pay, then they paid. So now we're back up to $2,000 in that account. We didn't spend anything. That's great. If no other entries went on and you had an allowance that was $2,000 and you didn't need it, that's wonderful. But we do like to be prepared for it, so that's why we set it up. The chapter goes on and talks more about, how to extend credit. Be careful. Make sure you read that. Be careful about who you extend credit to. A lot of times I hear these horror stories about people who go out and they, provide this big service like painting a whole house and they didn't collect any money up front. I actually know of a particular person who wrote a big check to a decorating firm and then they didn't receive any of the decorations that they ordered for their house. They were supposed to get furniture, they were supposed to get curtains and light fixtures, and now they're in court trying to get that money from the company. And obviously that is a bad situation too. So you want to make sure that whoever you are extending credit to, they are good people. You won't catch it all, obviously, but hopefully you're careful. Maybe take a 50% deposit before you provide a big service. I know a lot of companies require that you pay 50% down before they go paint your whole house or whatever. So be careful about that because it can really get you in trouble. Also be careful when you're looking at a company's financial statements. If they have a ton of money sitting in accounts receivable, then I would be a little bit concerned. Why do they have so much money in accounts receivable? I mean, most people now, either swipe their credit card or whatever, so they should be getting that money out of their accounts receivable monthly from their credit card company. So why do they have so much money sitting there? Especially if it's a large percentage in relation to their actual cash. You definitely want to be careful about companies who take too long to collect money from people who owe them money, because as we know, you've probably seen with your friends, if they owe you money, the longer the time that passes, the less likely you are to collect that money. So you definitely want to be careful about that. This journal entry here is, what do we do if we have a situation where we have a lot of accounts receivable and as the company, we don't have time to collect it? Now, a lot of big companies have their own collection department, so they don't have to worry about it. They have people working this all the time. Hospitals, a lot of large corporations, they have their own collection agency within their company. So they're calling people, sending letters, hounding them to pay their bills. Small companies, some medium-sized companies, can't afford that. So what do they do if they see themselves in a situation where they have a lot of money sitting in accounts receivable and they don't have the time or the energy or the person designated to be calling, emailing, and hounding this person? What do? What is their option? Their option is to go to a collection agency. So I put an example up here. Let's say you had accounts receivable of $600,000 and you are having trouble collecting that from the people who owe you money. What can you do about this situation? Well, you can go to a collection agency and say, hey, here are all the people, names, addresses, phone number, email, whatever you have on them that owe me money. And the collection agency says, okay, we'll take that from you. And the collection agency is going to take all of that information and actually turn it around and hopefully make more than $600,000, because they're going to hound these people. They're going to charge interest. They're going to go repossess goods, whatever they can do to get that value back out of it. Well, you don't have time to do that. So you go to the collection agency and you say, here's all the information. Now, what are you going to give me? And they're going to give you cash, but they're going to charge you a fee. So if it's $600,000, let's say they charge 2%. 2% of $600,000 is $12,000. So you see that I debited service charge expense $12,000. All of the accounts receivable gets written off my books. So it goes away, I'm done. And I actually leave there with cash of $588,000. Some people will say, oh, $12,000 is too much to pay them. I disagree. Would you rather have $588,000 in cash today in your hand, or would you rather have nothing? Because that's basically what's happening. You're not able to collect this $600,000 on your own. So you either have nothing or $588,000. I'd much rather have $588,000 and leave, and I don't have to worry about it anymore. So a lot of people use collection agencies. They're actually called factors, and what it is it's a third party that comes in, takes the debt off your books, and handles it themselves. So they collect the money from the people that owe you. Obviously, this is a wonderful option for small and medium-sized companies that don't have the time to focus on collecting all of those accounts receivable from the different clients that owe you money. So this is just a little snippet of some things you can do about accounts receivable and what do you do, how do you record who's not going to pay you, how to prepare yourself that some people will not pay you, and then what do you do if it becomes overwhelming? You can get rid of it with a collection agency. The chapter goes on to talk a little bit more again about how to extend credit to people, some red flags to look for. So make sure you read the chapter on accounts receivable and practice the homework and making sure that you understand the adjusting entry, the write-off, and the recovery. Thank you.